Welcome back, traders. Our next guest is here to help us make sense of the recent price activity in the dollar. Traders, let's welcome Alan Nuckman, the chief strategist at Agora Financial, to Futures with Lichtenstein and Hinks. Alan, thanks for joining us today.
That's what we're here.
I want to get right into it. We've got the dollar, which saw very limited movement in reaction to some of the activity we were seeing in the ES, NASDAQ, Dow, Russell. Alan, why do you think such a subdued reaction in the dollar last week?
The dollar got a little bit of bid there. It held firm. It didn't really go that much higher. We had the euro currency lose about 150 points, so we saw some turn there. But the dollar kind of held strong as, I guess, a reserve currency in case it got worse than it was. But that's what I was focusing on. Now, let's see if things now get more stable, if the dollar resumes its overall decline and moves down, because that could help out some assets that got hit hard last week. Gold was down 20 bucks. We had crude down, what, $6, a 10% drop in crude. Crude did come back down to that $59 double top breakout that we had in December. That held, so let's see if these guys can build a base and the dollar heads back down.
Good morning, Alan. Let's talk about the relationship between bond futures and the dollar trading, right? It looks like bonds are heavy again this morning. We've got the 30-year down and the 10-year. It looks like yields are going to approach 2.9 here, right? So give me that relationship that you see between bond futures or yields and the U.S. dollar.
It's an interesting dynamic. Now, bonds did get a little bit of flight to quality when things, the macro market was shaking up at the end of the week last week, but they've quickly given those back. So it looks like the 10-year is going to try and test that 3% that everybody's been talking about for a long time. Not today necessarily, but here at the future. So let's see how it reacts. Just like anything else, for me, as a price watcher, it's how markets act and react when they get to specific levels. Do they follow through or do they fail to follow through? Last week was a great example of that in the E-mini S&P. Now, everybody talks about what happened when we bounced off that 200-day moving average in the S&P, but if you look at the E-mini, what happened on Friday was textbook of how bottoms get put in. We saw the E-mini S&P test the lows from Tuesday night, that extreme low, at 25.29, got to 25.30, and then a U-turn moved up 100 handles in about an hour and a half. So that's how bottoms get put in. Now, we haven't seen any of that kind of capitulation action in treasuries yet. Still waiting for that. A couple of times we've seen new lows and then a higher close, but it's been quickly erased. So the relationship with the dollar, I don't know. It's an interesting one because the dollar's been on a straight down decline, essentially 2017 and for the first part of our year, whereas treasuries have disconnected from their usual role where if stocks go down, treasuries go up. So it's a little bit of a mishmash right now trying to sort it out.
It sure has been, and we also had the bonds, which just traded a new 2018 low in the overnight session. But Alan, kind of a light day in terms of economic data scheduled for release. We do have the Treasury budget this afternoon at 1 p.m. Central Time. I'm curious if you think there's any chance that we'll see some dollar movement in reaction to that.
I think once the market stabilizes more, and like I said, I think this is a great sign that we saw on Friday in the S&P. That's exactly what I was looking for. That's how bottoms get put in, a double bottom, an attempt like that. If you look at it in context, it was a 5% decline last week. Now, it was straight down for 2 weeks. Remember, it was only 2 weeks ago Friday that we made the all-time forever highs in the stock market. So it was a very quick, unkind unwind, and I look at it simply as profit taking as so far. That's the way it is. That's the way it stands, in my opinion, until proven otherwise. So looking at the macro market, I think that has has more control over what happens in any other asset class right now, is if we can get some stability. Now, the best sign that I had last week was that nonsense that happened on Tuesday. When we had the VIX get up to 50, that extreme short squeeze, we saw what the fallout of that was, and then the decline. So that was a key reversal on Tuesday in volatility. We never got even close to that on Thursday or Friday when the markets were down on their lows. So that was a very healthy sign of stability there. And I think the VIX squeeze was really the main news of last week, and I think that's healthy that happened in a very quick fashion. That's the beauty of electronic markets. What used to take weeks to get digested by the market, news and events and so forth, now with electronic markets, you can see how quickly that can be flushed through the system, and now that's beyond us. behind us so we can move forward.
Alan, let's pivot over to the Fed funds rate and that's effect from last week. As you saw during the sell-off last week, the Fed funds, the probability of a rate hike in March went down into the 60s in terms of percentile.
Right.
It's back up in the mid-70s now. It'll even be higher by the end of today's trading. Was this just a head fake that this market should have ignored? I don't think there's any chance that they're not going to raise rates in March.
Yeah,
give us your thoughts.
Yeah, they've got a plan. Let's not doubt the Fed. The price action reflects great work by the Fed over the last 9 years now. They know what they're doing. They know how to handle this. They've played their cards perfectly over these last years. I don't expect anything any different this time. I think we had a little bit of nervousness by traders. You know, we backed off a bit, but again, stability will cure all these ills and all of these major concerns that we had last week in a lot of these markets. What I'm also looking for is, you know, we were talking about the dollar, is look for the euro currency to get back above 124 and shake off this bit of a sell-off there. So watch for that. That's kind of the midpoint of this drop from 125.50 to 122.50 or whatever it was. So let's see if the euro currency can make another push to the upside. The dollar resume its slide, and then we'll be back to some of the strong overall trends that we've seen in a lot of these assets. But we saw some unwind, which is healthy and needs to be done from time to time. Let's see how it reacts and responds in the future here.
All right. Hey, Alan, we've watched the dollar in this historic bull market. We're pretty aware of how it trades as stocks are going higher. But what I'm wondering now is we've started to pull back off those all-time highs. What can we expect to see in terms of dollar price activity if stocks start to go lower?
Well, that's interesting. I again focus more on, I think, the euro currency and you know how it's behaving. And again, we have to put in perspective. It's at 123 or whatever it's at right now. That much more value than the dollar index. And look what the euro's been through in the last few years. So it's remained strong and stable in comparison through some of the worst of times. So that shows an internal strength there. And we know the politics here in America that, you know, you're not supposed to say it out loud, but they did a couple of times. And a weak dollar helps exports and helps corporations. And what's the number one focus for the policy focus for the government here in the United States is to help corporate America. So I think we're going to continue on the path that we've been. I'm not a guy to call these reversals. We'll look to see where we are. You know, it's like I said, it's been 2 weeks of some volatility and some action and some testing of these trends. Let's see how these trends resume their overall rallies here in the next coming days, next coming weeks, and get back to a little bit of normal for the bulls.
All right, Alan, one last thing here. Let's talk about the euro for a while, the 6E, right? It's been incredibly strong lately. Now, do you think is that a Brexit trade? Or is that kind of a precursor to maybe the Eurozone maybe starting to tighten policy or less QE? Give us your thoughts on the euro currency.
Well, I'm a price guy, and the price has been extremely positive. We talked a number of weeks back that I had expectations getting to 125, and then, you know, from reward to risk, I didn't see that much more upside. I saw more downside risk than looking for it to really push that much higher above 125. So that had already occurred, and you know, the question now is where do we move next? Obviously, to something that we don't talk about enough, I don't think, is that how this has been a global growth rally. It's not just the United States stock market that's done very well. Every market in the world has done extremely well over the last 5 years. So this was a global pullback. So I look at this as, again, profit taking. But looking at the Eurozone and looking at Europe, you know, they had some growth numbers, and I think they're continuing on their path for growth. And again, this was just a pullback. I think we kind of started this unwind, but it looks like we're finishing it with that action on Friday. I'm looking for these overall trends to resume where we were going, and look for the euro currency to continue to climb. I'd have to do a little bit of math on this, but you know, the pullback was about 3 points, so 128 would be the measure move target on the euro on the upside.
All right, well, Alan, we're going to be keeping a close eye on that. A lot of activity last week. We'll see how things start to play out this week. Thanks for coming on today and sharing your thoughts with us this morning. Always helpful in terms of getting us dialed in on what we should be looking for. Traders, that was Alan Nuckman. He's Chief Market Strategist at Agora Financial. With the dollar off the 2018 low.